हरे कृष्णा। एक बार आपका फिर से स्वागत है मेरे इस चैनल पर्पसफुल प्रॉस्पेरिटी के ऊपर। और जैसा कि आप जानते हैं, एज यू ऑलरेडी नो, दैट वी आर गोइंग थ्रू trying to extract the wisdom from this little book of common sense investing by John Bogle. We have finished the introduction, and today we are going to start with chapter 1. We are trying to extract the wisdom from chapter 1. The chapter 1 say the parable. So this is a small story, and this story is being told talk about uh, how an investor behaves and how he is not able to create enormous wealth. So I should relate this with the story of retail investors actually, because they are the one who are actually making most of the losses and not able to create any wealth even after following the best which they are able to do. So let's just try to understand how the first of all understand what are the reward and losses of investing. So the chapter is saying that the total reward is always a sum of your earning growth as well as the dividend of corporations. And this investment is compounding over a decade and creating a huge wealth for us. And if you are doing this, then definitely you are playing a winner's game. At the same time, it's also informed us that there's something called losses, which are a sum of your investment cost plus your capital gain tax. So if you're buying and selling more often, then definitely there will be more of capital gain tax, and there is some investment cost also. So both of them combined together is becoming your losses. So we have to minimize our losses and in order to get the maximum of total rewards. So here I am just trying to give a brief overview about the evolution of Indian retail investors. So as a retail investors, we have all started, I think, with investing journey, beginning with fixed deposit, national saving certificates, the public provident fund, the employee provident fund, etc. Uh, then some of us feel that this is not enough or it is not beating the inflations. So in a way, we are right. Uh, but then some of these smart investors, so-called smart investor, they started to getting these investing suggestions based on their friends, relatives, or some of them uh, try to doing that start stock picking on their own. So they try to play this game for a couple of years, and then they realize that whatever we are doing, even with most of our efforts, we are not able to even beat the fixed deposit returns. So what is the use of that? So they end up uh, being in touch with some financial influencer or some stock picking experts. We have many WhatsApp and Telegram channel where people are claiming themselves as stock picking experts, and many people are in fact paying the membership fees for such channels as well as these groups. And this is again costing them some cost, and definitely when they are incurring some cost, they are going to lower their returns. Then they continue this for a couple of years, then they further realize that this step is also not working for me, so I had to do something else. Then they came up about these products of mutual funds and the PMSs. I think PMSs only people who are having a lot of money they use this because the minimum ticket size is large. So in mutual funds, they try to start investing in mutual funds. Sometimes they see their mutual fund is performing good, and if they are trying to pick up the best mutual fund, then as soon as they invest there, it will become the worst mutual performing fund, and they again lose their money. Then they again take the money out from this thing, put into another mutual funds, and then that mutual fund start performing bad. So in that way, they are incurring a lot of cost by this capital gain as well as investment cost. Then next comes they look for, okay, why not look for somebody who can help us select who which is the best mutual fund. So they go for some financial planner and investment consultant, and once again these planners and consultant also take some fees. So this is again lowering their fees. So you are paying some fees to mutual funds, you are paying some fees to your financial planner and consultant. Definitely this will be going to lower your return. So you are the more you are trying to increase your losses, which is the investment cost, definitely your returns are going to be less. And after following this also for a couple of years, then suddenly you realize that you are not able to beat the index returns. And that's where the index investing come into the picture. And you really need to understand that in order to be a part of India's growth story, we have to start investing in the India's indexes, which is Nifty 50 or 500. They are going to give you a return which will be almost equivalent to your inflation plus GDP growth. So this is the evaluation. I think many people will be at different stages of this evaluation, but I would say if you are really intelligent and don't want to wait for those many years of the learning, then I would say directly go for this index investing and you will do much better than any average investor. So the in the moral of the story, the it is being said that everybody should go back to square one. So that means get rid of all your helpers, your brokers, your money managers, your consultants, your advisor. Get rid of all of them because they are increasing your investment costs. And if you do this thing, you are definitely going to get the 100% of this whatever corporate India is earning. And that way, if you do it, continues to do it for a very long period of time, you are going to get a huge wealth. So Warren Buffett is suggesting that returns decreases as motion increases. So more you trying to do buy and sell, more you try to become timing the market, more you try to beat the market by going in and out, definitely your returns are going to be less. So for a retail investor, he is simply saying that buy something of low cost, good product and hold it forever. That's the way to make wealth. For the John Bogle is adding to the moral of the story where he says that the investing is not merely as difficult as it look. Successful investing involves doing a few things right and avoiding serious mistakes. And what are those right things? That's what we are trying to learn in these books. And definitely we are also learning what can be the mistakes that people are making so that we can avoid making those mistakes. Let's just get the knowledge from these great investors and imbibe in our life so that we can also become great. So, successful investing is about owning businesses and reaping the huge rewards provided by dividends and earning growth of nations' corporation. The higher the level of their investment activities, the greater the cost of financial intermediation and taxes, and less the net return that shareholders receive. So simply buy the index fund and hold it for your life. That's a way to make wealth. See, very simple. It's a common sense. Further, John Bogle says that while the interests of the business are served by simply saying that don't just stand there, do something. And I think that's what the influencer, the advisor, the consultant, everybody is doing the same thing. Every time you meet your financial advisor, he's going to advise, okay, this perform fund is not performing well. You exit from this A, you come into the B. He will say, okay, this AMC is not performing good. You switch to another AMC. So this is something going on continuously, and then that's ending up these investment costs as well as the capital gain taxes, which are the losses, and you are not going to make wealth. But John Bogle says the interest of investors are served by an approach that is a diametrical opposite, where it says that don't do something, just stand there. So we don't have to do this buy, sell, buy, sell. We just have to buy the index fund and forget and hold it for the life. That's a way to make wealth. So further in the book, he's talk about a central message about the book, where he says that the intelligent investor will reduce to the bare bone minimum the cost of financial intermediation. That's what common sense tells us, and that's what indexing is all about. So we understand from Warren Buffett that investing is all about common sense, and this book is giving that common sense that we have to be investing in index funds. That's a way to make wealth. The investment, Mr. Jack Mayer, who is the former president of Harvard Management Company, he's saying that this investment business is a giant scam. So most people think that they can find managers who perform, but most people are wrong. I would say that 85 to 90% managers fail to match their benchmarks. Look at this statement, 85 to 90%. So if you are trying to do something, uh, trying to pick up a fund and saying that I'm going to beat the indexes, so there are 85 to 90% chances that you are going to fail. So this is what I called, or the Mr. John Bogle is saying, it's a loser's game. So become a informed investor and don't play this loser's game. Be a part of winner's game. In one of the interview with Mr. Jack, it is being asked the key learnings from his investment journey, and he's summarizing that into three simple points. The first, he is saying that get diversified. Second, he is saying that you should keep your fees low and don't go for these hyped or expensive funds. In fact, go for this low cost index fund. And finally, he's saying invest for the long term. Very three simple statements, common sense, and that is all about investing. And finally, he conclude that investors should simply have index fund to keep their fees low and their taxes down. Then we have another Mr. Burton, Michael. He's saying that index fund have regularly produced rate of return exceeding those of active managers by close to 2% points. Active management as a whole cannot achieve gross return exceeding the market as a while, and therefore they must on an average underperform the indexes by the amount of those expense and transactional cost disadvantages. So we really have to understand these active managers are not creating wealth. The wealth is being created by Indian corporates through their earning growth as well as dividend. So when somebody is managing your fund and charging some fees for that and making these transactional costs of buying and selling, definitely whatever the corporates are earning, your growth is will be subtracted from these uh, transactional cost as well as these capital gain taxes. So definitely your returns will be low. And the data is suggesting that it will be 2% difference. Even a zero point 0.5 difference over a long period of time of 30, 40 years, it's going to make a huge difference. And here we are talking about 2%. So that's a really large thing. So as an intelligent investor, we really need to think and don't do this mistake. Further, he's saying that the experience conclusively shows that index fund buyers are likely to obtain result exceeding those of typical fund manager, whose large advisory fees and substantial portfolio turnover tend to reduce investment yield. And many people find the guarantee of playing the stock market game as per every round a very attractive one. The index fund is sensible, serviceable method of obtaining the market rate of return with absolutely no effort and minimum cost. Look at the last line. So, in order to get your fair share of market return, you don't need to put any efforts. It's that simple. It's a common sense. And you are able to get that with the minimal expenses. And how you do that? By investing in an index fund, a low cost index fund. That's the summary Bert and Michael is going to put in front of all of us. So once again, thank you for being part with me and going through this session. I hope you really liked it. If you really enjoyed this thing, please like, share, and subscribe so that this kind of content can reach to the more audiences and the retail investor can really evolve from this great knowledge by Mr. John Bogle. So once again, thank you. Hare Krishna.